There are two main reasons that the market is struggling right now. The first one is because of the Federal Reserve, where there's been a big change as we saw last week. And by the way, as usual, all this research is coming straight from MacroOps, our global macro research and consulting firm. So a big reason why the market has been taking off for the last few years is because of the way that the Fed changed previously. Their new goal was flexible average inflation targeting. So the idea was that they would take a more pro-cyclical approach, meaning that if the economy was heating up, they would heat it up even more. Instead of what the Fed has usually done forever is when the economy is heating up, they would cool it down because they want to provide balance, right? But what they changed to was actually heating it up more, as we said, and letting inflation run above target. So the reason they would do that is because they were hoping to make the labor market even tighter. That way they could raise employment levels among the people that are most marginalized. Now, Powell has done a good job all year reinforcing this idea. And obviously markets love this idea because it means lower interest rates for longer, even when the economy is doing well. So even with increasing talk of tapering asset purchases, which means less liquidity in the system, which, as you know, is bad for asset prices like stocks. Stocks love lots of money everywhere because it just pushes the prices up. So even with increasing talks of tapering those asset purchases, meaning less liquidity, he made a strong effort to de-link taper from raising interest rates. So he's saying, okay, even though we're going to stop buying as much, don't worry, interest rates are going to stay low. And he talked down inflation concerns, continuously marking them as transitory, saying, hey, this is just a post-pandemic thing, don't worry. But last week, something changed, and this change matters. So Powell ended up greenlighting a November taper, and he said he expects it to end by 2022. Now, this is sooner than what was first thought, and it opens the window for a hike at the end of 2022. Now, more importantly than that, Powell didn't make an effort to distance himself from what the whole FOMC commission was saying. Well, that's redundant, FOMC commission. But anyway, he did not try to talk down inflation concerns, which makes it look like the Federal Reserve is becoming more hawkish. Now, typically, just one hike planned for later next year would not be a big issue, but it does matter now because of what it does to the narrative. If the Fed was trying to make us all think for years that they were just going to let inflation run, this is different than that. So now we got US assets trading at record multiples, right? And inflation is running well above trend, and it's the primary driver keeping these long duration assets buoyant. The interest rates are causing all of this. So if Powell doesn't assure everyone that interest rates are going to stay low, well, then we might have some problems in the market, which is exactly what's happening now. So unemployment hit a low of 3.5% before COVID. Now, the Fed originally said that maximum employment was likely at some level below that. And that's why they were saying they were going to do this flexible average inflation targeting. But now their own forecasts are saying that unemployment is only going to dip below 4% by the end of 2022 and into 23. So why would they turn hawkish if their goal was to reduce that, right? Well, the reason must be because they are spooked by inflation. So inflation expectations for 1 and 3 years out are becoming unanchored. And that's what you can kind of see right here. It's really taken off. So the Fed is obviously concerned about inflation going 70s style. So it looks like they're deciding to revert back to their old ways. They want to stomp demand to manage these prices, which meaning increase interest rates to do what? Reduce liquidity, and then there's not as much demand. So the market is starting to pick up on this change. The Fed fund futures for December 22 and 23 both perked up last week and are now nearing new highs. You can see that right here. So this tightening has definitely started, and it's happening as the change in our global growth is actually slowing. And it's not the change in growth, it's the change in the rate of growth is what I mean. And we're moving off the massive liquidity injection that has really helped markets in the last year. So Druckenmiller, his quote pretty much sums up what's happening. And we've said this quote so many times, so you probably remember it. But contrary to what a lot of the financial press has stated, looking at the great bull markets of this century, the best environment for stocks is a very dull, slow economy that the Federal Reserve is trying to get going. Because once an economy reaches a certain level of acceleration, the Fed is no longer with you. The Fed, instead of trying to get the economy moving, reverts to acting like the central bankers they are and starts worrying about inflation and things getting too hot. So it tries to cool things off, shrinking liquidity, which is exactly what we just talked about. So now what we're facing is the Fed no longer being with us, at least for the moment. That means good news in the economy will now be interpreted as bad news, if you guys remember that from a few years ago. Falling unemployment, strong growth, and non-transitory inflation will continue to nudge the Fed further towards the hawkish side of the spectrum, meaning raising interest rates, at least until something breaks, which we expect it will. And that goes more into the long-term debt cycle. So that's the first problem. The Fed is not our friend anymore. Now, the second problem is, of course, China. Now, we talked about in previous videos that Evergrande was not a Lehman, but it is a symptom of a much greater problem. And basically, it's just one aspect where China has to decide whether they want to maintain their high growth by continuing to leverage, because guess what? If you think the US is bad, China has done crazy things when it comes to leverage. So they either do that or they deleverage the economy and accept significantly lower trend line growth. So Xi has finally been able able to choose the second choice because what has he done? He consolidated his power so that he's the emperor now, and he cracked down on all his rivals. So there's no one to challenge him as he brings the economy down, which he has to do. So what this means is that China will be shifting over time from its rolling credit-fueled growth cycles to a much lower one. Think 1 to 3% GDP growth. So this is going to have significant effects on growth and inflation over the long term, especially in select emerging markets dependent on this Chinese demand. So one thing we've already talked about, you can see this chart here of land transactions. They have absolutely plummeted because of China's crackdown on a lot of different things, including real estate. So as we've said in previous weeks, we got to watch base metals here because they are definitely going to get hit because China was the biggest demand for most of these materials. So we'll do another video on the bigger impact of China, but just know that it is the China and the Fed that's going to hurt growth. And even more importantly, over the short term, they're going to drag down expectations from elevated levels like we've seen. Because for the past few months, we've been trying to play this final buy climax to top off the S&P's year-long rising wedge. And then we thought, after that, it would be a 2 to 3 month, 10 to 20% correction. But it looks like things are changing once again. And I know we've gone back and forth on this a lot because things do change and you have to change with it. So we got a lot of weakness in market internals, and you've already seen it show up in what's happening in the actual price. This does not look great. But here's just some highlights. The S&P percentage of advancers are at their lowest level since the COVID bear. The McClellan summation is at the lowest level since COVID. 52-week lows are clustering for the first time since COVID. And percent decliners is at its highest level since COVID. So a lot of bad things. Trend fragility hit the 90th percentile. Aggregate fund flows hit the 99th percentile. Hedge fund positioning is at its most long since October 18. And positioning and sentiment, you remember, it is like an opposite indicator. So if people are super bullish and super long, that just means that there's a lot of money to unwind. Versus if they're really bearish, then there's more money to come into the market. So being their most long is a bad signal. So if you look at the S&P, we just got our monthly closing bar, right? And these have the best signal to noise ratio because they're so long term. And you can see we finally got a bearish bar. And this is after 7 straight bullish bars in the S&P. So that's a big signal right there. So historically, this often leads to an extended 1 to 3 month consolidation or pullback with drawdowns in the range of 10 to 20%. Now, this doesn't mean that it's going to happen because the S&P could very well run up and make new highs in the coming weeks, but we're talking about the odds here, the probabilities. And we see the odds are in favor of more downside in the intermediate term. So if you look out longer term, 7 consecutive monthly bull bars shows extreme buying pressure. There's only been 6 other instances of this in the S&P's history. So that's not even a surprise given how much liquidity has been pumped in the market over the last 18 months because of the whole COVID thing. Now, again, longer term, this type of buying pressure creates a momentum of its own, which is why a larger pullback in the 10 to 20% range is likely to get aggressively bought. So this pullback is short term. But again, how you play it is going to depend on your strategy and whether, what time frame your strategy is in. So our backtester shows the forward 10-month returns following 7 bull bars skews strongly positive after an initial 3-month window of weakness, which is what we're likely going to face now. Now, the chart we're still keeping an eye on is this Russell right here. You can see it's still going in its sideways consolidation pattern. So it's really shown some resilience against the risk off in the other major indices over the last 2 weeks. So the direction it finally breaks in will likely signal the way for the next few months. So we're just waiting on that. So you can see here on the weekly, the S&P is broken below its rising wedge, which is bearish, of course. And a weekly close below its Bollinger Band midline would open up the market to significant downside. So we're keeping a close eye on that. It closed right on the midline last week. And this midline is this little gray line here. I don't know if you can see it. What we do have in the daily chart, though, is a potential double bottom. But a move below Friday's low would open it up for more downside as well. So again, different time frames that you want to look at. But as of this recording, which is Monday early morning, you could see it doesn't seem that we're at danger of breaking those lows, but who knows? There's still time, of course. NASDAQ looking much more likely to break those lows, so we will see. Now, as always, if you want to make sure that your risk control is in place during this squirrely time in markets, then make sure you check out our free training. It'll show you the exact strategy we use to control our risk, but still make great profits. I'm going to put a link to that training right here. Make sure you check it out, and I will see you there.